Welcome. Today, we're going to tackle a really key part of every retirement plan, required minimum distributions, or as most people call them, RMDs. This is that moment when your whole savings story flips from putting money in to strategically taking it out. And believe me, the rules really matter. So think about it. You've spent decades, literally decades, diligently putting money away, watching it grow. But when it's finally time to start enjoying that money, well, it turns out you're not the only one with a plan for it. The government has its own set of very specific rules, and today we're going to make them super simple to understand.
Here's how we're going to break it all down. We'll start with what RMDs are and why they even exist. Then we'll cover which accounts you need to worry about and the timeline you've got to follow. After that, we'll walk right through the calculation, look at the pretty serious penalties for getting it wrong, and wrap it all up with a simple checklist to keep you on track. Sound good? Let's dive in.
All right, so first things first, what exactly are RMDs, and why do they even exist in the first place? Well, it really all boils down to one of life's two certainties: taxes.
So here's the official scoop. For years and years, your money's been growing in accounts like a traditional IRA or a 401k, and you haven't been paying any taxes on all that wonderful growth. An RMD is basically the government's way of saying, okay, fun's over. It's time to start taking that money out so we can finally get our tax share. I love this way of thinking about it. Your retirement account has been this perfect, tax-protected greenhouse for your money. You've been carefully nurturing your savings, and now the IRS is knocking on the door saying it's harvest time. Now, you don't have to take it all out at once, but you do have to start taking out at least a minimum amount every single year.
Okay, so now that we get the why behind RMDs, let's figure out which accounts they actually apply to. And this is key because it's not every single retirement account you might have.
And really, there's a super clear line in the sand here. Over on the left, you've got all the tax-deferred accounts, your traditional IRAs, 401ks, and so on. All of those require RMDs. But look over on the right. The big standout, the major exception for the original owner is the Roth IRA. And the logic is simple. You already paid your taxes on that money before you put it in. So the government doesn't need to force you to take it out to get their cut.
But, and this is a huge but, that special RMD-free status for Roth IRAs, it doesn't last forever. The moment that account gets passed on to a beneficiary, RMD rules will almost always kick in for them. That's an absolutely critical detail when you're thinking about estate planning.
Okay, let's talk timing. This is honestly where a lot of people get tripped up, especially in that very first year. And missing these deadlines can have some real financial consequences. So let's make this timeline crystal clear. Now, this timeline can create a kind of a trap in your first year. The year you turn 73, that's your first RMD year. Now, the IRS gives you a little grace period. You have until April 1st of the next year to take it. But here's the catch. Your second RMD is due by December 31st of that same year. So if you delay that first one, you end up taking two big distributions in a single year, which could easily bump you into a higher tax bracket. That's why most advisors will tell you to just take your first RMD in the year you turn 73 and avoid the whole mess.
Now, there is one pretty big exception. If you're still working at age 73, you can often delay taking RMDs from the 401k at your current job. Now, this doesn't apply to any of your old IRAs or 401ks from previous employers, just the one at the company you're still working for. All right, so the big question, how much do you actually have to take out? Now, this part might sound complicated, but I promise you it's really just a simple division problem. Let's break down the formula.
Seriously, it's as simple as 1, 2, 3. First, you grab the value of your account at the very end of last year. Step 2, you find your age on a special IRS table to get a number they call a life expectancy factor. Then, step 3, you just divide that account balance by that factor. That's it. That number is your RMD for the year.
Now, a lot of the custodians, the companies that hold your IRA, they'll calculate this for you, which is really helpful. But, and listen to this, the IRS is incredibly clear. The buck stops with you. You are the one who is ultimately responsible for making sure the withdrawal is the right amount and that it's taken on time. So, it's always a smart move to just double-check their math. So what happens if you get it wrong? Let's dive into those crucial what-ifs, the penalties you could face, and the really specific rules for anyone who inherits these accounts. If you don't take your full RMD on time, the IRS can hit you with a pretty nasty excise tax. The standard penalty is 25% of the amount you were supposed to withdraw but didn't. Yeah, that is a significant, painful hit.
Okay, but there is a little bit of good news here. If you realize you made a mistake and you fix it in what the IRS calls a timely manner, usually within 2 years, they will reduce that penalty down to a more manageable but still pretty painful 10%. So the lesson here is obvious. If you make a mistake, act fast.
And for your heirs, you really need to pay attention because the rules have changed in a huge way recently. The old stretch IRA, which let beneficiaries stretch out withdrawals over their lifetime, it's mostly gone. Now, thanks to the Secure Act, most people who aren't a spouse have to completely empty the entire inherited account within 10 years. This can dramatically speed up the tax bill for your heirs, and it makes things like Roth conversions a much more important part of estate planning.
Whew. Okay, I know that was a ton of information. So, for our last section, let's just boil it all down into a simple, actionable checklist you can use to stay on top of this whole process. All right, let's run through it. First, know your start year, the year you turn 73. Easy enough. Next, identify every single account that needs an RMD. Get those deadlines, April 1st for the first one only and December 31st for all of them, on your calendar. Always double-check the calculation. Oh, and here's a pro tip. For your IRAs, you can add up the total amount you owe and pull it all from just one of those IRAs if it's easier. And finally, of course, withdraw on time and make sure you understand the plan for your beneficiaries.
You know, at the end of the day, RMDs aren't just some annoying rule you have to follow. They really mark the beginning of the decumulation phase, the time when you actively start using the incredible nest egg you've saved. And if you think about it that way, it kind of transforms it from a chore into a really core part of your retirement strategy. Thanks for joining us for this explainer.